a lot of people here want to do good. Everybody wants to do good. Nobody wants to do bad. And it all sounds nice. This idea that companies want to be environmentally conscious, socially conscious. They want to have a social mission. They want to be mission-driven. They want to have values. We hear millennials have values. They want to work with companies that have values. They want good corporate governance, all of these things. But ultimately, does that actually equate? Does it truly correlate to better companies that make more money, dare I say, profits, and effectively have higher stock prices, right? That is sort of the fundamental question. So is this real, or is this just great marketing? And Finucane.
It's real. So let me defend myself here in terms of ESG. What's real about it is, first of all, I don't think anyone would argue that climate change is real. I don't think anyone would argue that...
I know a guy.
Most people would not argue over time that climate change is real. I stand corrected. Most people would agree that it would help in the world if women could participate as well as men. Perhaps we could solve more problems. Most people would agree that good governance leads to less volatility. Now, these things do not have to be in spite of performance. I think, and we think, it enhances performance.
And that's the whole thesis for what you do in terms of investing.
That's right, and we kind of double down on that in that we are not just looking at companies that follow everything that Anne said. We're kind of looking at and investing in companies whose core business is one or more of those things. So the biggest theme, for example, we invest in today are companies that are developing technologies for clean energy and that go right at the heart of what is it that we need in the next 5, 10, 15, 20 years to completely phase out of all forms of energy, get out of the Stone Age before we run out of, even though we will still have stones around, and make that transformation, do it extremely profitably, and do it at large scale, and in the process create companies that are worth billions and trillions of dollars.
Before we get into this, I mentioned this ESG, and the reason why it's important is because it is 3 different words, but I just wanted to try something on you, which is that the 3 different letters represent what I would describe as at least 2, if not 3, very different things. And I wonder why we are scoring, if you will, or putting companies in buckets. And by the way, it's not just how we talk about them. They're now mutual funds and ETFs and all sorts of investment profiles that are approaching investing like this, including large pension funds. But the reason I mention that is there's environmental and social issues. I'm going to put that on one side. And tell me if you disagree with how I'm approaching this. And the other is governance. Governance is a very different thing to me in some ways, because governance is about shareholder rights. It's about compensation. It's about, now you can put it together, there's even diversity on boards and how the boards are structured. Do you think about them all as one thing? Because what's happening right now is companies in their early stages and later stages are being scored, if you will, on all 3 together.
Well, it's an organizing principle. So in any organizing principle, there are many things in it, and each of them has its own elements. So, I mean, you can argue that they don't fully go together. I would say they do go together because we used to talk about CSR, which was all sort of the social...
Right. Corporate social responsibility.
Right, which was kind of with governance.
Right.
But it left E out, which is where we actually see making money. So this was a way of, it's an organizing thought. I think that they work together. If you govern yourself properly, you will be thinking about the world about today and the future. If you're thinking about the world today and the future, you're thinking, how are you treating your employees? How are you treating your customers and your clients and the communities in which you live? That's the social. If you're thinking about the present and the future, you're thinking about the world around us. That's the E. And for Dipender and for Bank of America, we see this as more than good governance. We actually see this as a business opportunity where who would argue that it is not better to save and spend less on energy today than we have in the past. Who would well, maybe you would argue it, but
I just have to play devil's advocate today because both of you are on the same side.
So I'd raise it a level. I'd use the word that you used in the beginning, which is good, right? And so I think the bigger topic here is, can you invest in companies that do good for the world and make a lot of money?
and get a market return.
That's outsized market return, beat the market. So E and S and G and A and B and C and D, there'll be lots of alphabets that you can fit under that. And I think ESG is one organizing principle, as Anne said, CSR is another. But I think the bigger issue, the bigger and even more interesting thing is, what is the opportunity to invest in companies that are going to do good and be highly profitable and deliver all the returns that you want?
Okay, so
But wait, that's where we digress a little bit.
Okay.
So Dipender is going to go for social impact and market or better than market return. I think that we would say there are occasions where the S and the G are required to make a
The S being the social part, the G being the governance part.
right, in making a decision around E. So some E
The
is-
environmental part.
some E, some environmental parts are you can get market or better return. In some cases, you can't. An example would be we're part of a consortium that helped preserve a wildlife sanctuary in Kenya. In order to do that, you needed some first loss money, you needed a development bank, you needed a couple of commercial banks, we being one of them, and you needed some private equity. And on a blended basis, we could get a return that did not beat the market, but it was reasonable enough, and it was, from an investor's point of view, seen it the same as maybe a municipal bond. So it gave you equal return as a municipal bond, but it didn't give you equal return than some other elements of the market.
You were an early investor in Tesla. What did you see beyond a great and fascinating founder with a remarkable vision and a persistence to make it happen? Meaning, was that really a bet on the environment and battery-powered cars, or was that a bet on a guy who could make it happen?
So it was more than one of those elements, but first and foremost, it was a very fundamental thesis that said the time had come for electrification of transportation. No ifs, ands, or buts. The time had come to get out of ways of moving people and boxes with millions of explosions happening under the hood that were turning an axle and that were turning the wheels and getting you from one place to another. It was as simple as the time had come 50 years ago for computers. And so first and foremost, it was about electrification of transportation was a great business idea. It was a great technical idea. It was going to win very soon. And it was going to win with orders of magnitude, not 10%, 20%, 30%. So that was sort of the basis of, is this something that's investable? At the same time, we looked at, there was no way for this, in the bigger scheme of things, there's no way for this world to continue going in transportation with the old ways. If you look at some of the biggest countries in the world, the per capita consumption of transportation is 1/20th, 1/30th. In India, it's like 1/40th that of the US. As you look at these countries with 2 billion people between China and India, and most of them without cars, and most of them with the aspiration to have cars and transportation, there is no way this world survives by doing it the same way that you do it. So if you can marry a great product, which wins on technology, engineering, and science principles, if you marry a great product that is just going to be better on every axis, whether it's performance, whether you're a fast car nut, whether you're a comfort nut, whether you're a luxury nut, whether you're what's the cheapest way to get from point A to point B, it doesn't matter which of those axes you choose. If you combine that with passionate teams, which again goes without saying in our business, if you combine that with people who have that vision and have that clarity of purpose when everybody else around them, especially the big incumbents, are saying, no way, this is never going to happen, you have a winning formula for an investment.
But what about cost? I mean,
Cost is going to be significantly lower than
Over
anything
time.
comparable. Very soon. In fact, the Model
But
3.
not yet.
The Model 3, which gets released later this year, in its class will now be the cheapest vehicle to operate.
Okay.
If you look at the science and math, I don't know how much you want to get into that, but let's look at a very fundamental thing. If you take a barrel of oil and do something really crazy to it, which is burn it to generate electricity, which very few people in the world do. It's a really bad way of generating electricity. It's an expensive way of doing it. But let's say you do it, hypothetically. And then you transmit it over transmission lines, and then you charge an electric car with it, and you drive an electric car from point A to point B. And you compare that with taking a barrel of oil, refining it like we do today, getting it into the distribution, filling up your gas car with it, and driving from point A to point B. In the best case, the electric version is 7 times better than the incumbent. In the worst case, it's 4 times better. So it's just hands down a better cost equation, whether you look at it from an energy cost or a total cost. And when you have principles like that of physics, you win.
Okay, let me ask you one more question on that, and then I want to get to Ann, which is this. At least for Tesla, and for many of the clean energy bets that you've made, part of the bet is not just on the technology itself, but to some degree in terms of the economics of it, the bet on a government subsidy. How does that translate or relate to how you think about the investment?
So in most of these markets, it's a question of how you view government subsidies. Government subsidies come in so many forms. Most energy markets around the world had government assistance of some form or the other to begin building something. So it's a question of what happens in the beginning, right? And I would say, having seen what's been happening over the last 20 years, in totality, if you look at the subsidies that the old energy industry got in its birth and in the development, which was obviously a wonderful thing for economic development in most of the world, and you compare it to the economic subsidies that the solar industry, the electric car industry, et cetera, have gotten recently, it's not even a comparison. I mean, people make noise because you politicize it and you talk about companies like Solyndra, et cetera, but those are drops in the bucket. I'll give you an example where subsidy hasn't been that much of an issue. If you look at what's happening in most of Asia today, and for those of you who'll see An Inconvenient Sequel, which was the sequel to An Inconvenient Truth, you'll see this right in the heart of it. The Paris Agreement was sort of stuck because a couple of countries were saying, there's no way you're going to prevent us from using coal and force us to use solar and things like that because it's going to be more expensive for us, and you have to subsidize this. Well, in that short 1.5 years since that happened, you go back to some of these countries and they're like, there is no way we're doing coal. It's more expensive. So rather than think of it even as a subsidy, they're looking at the bare cost and saying, this is now cheaper. And so I think that subsidy piece, to begin things, to set things up, I think lots of governments see a good thing and say, I want to build public transportation, I want to build energy, I want to build da-da-da-da-da. But just on the basic cost and the science and the scalability, I think it beats it hands down.
Take us inside the firm being Bank of America. And you spearheaded an ESG campaign, not just publicly, but internally.
Right.
How has it manifested itself? What does it look like? What has changed as a result of the work that you've been doing now for the past 3 or 4 years on this?
Well, 3 years ago, I think it was hard to get anyone even to the meeting. So, I mean, just to give a frank sort of assessment, today it's every line of business, the heads of every line of business meet. We meet formally 4 times a year. We meet informally quite often, and it is a place where we ideate a social impact bond, a green bond, underwriting green bonds, a decision around a social decision we'll make about a product or a service, or that we're going to go to 16 weeks of maternity, paternity leave. That's where this happens. So whether it's the head of HR or the head of investment banking or the head of investment services, they put forward what it is they want to do. It's a debate. This group doesn't decide yay or nay. It just decides whether this is it's something we can advance for ESG, and whether sometimes it's in a nascent stage and they need support in the company. Sometimes it's a matter of opening up the risk box a little bit so that we make an investment sooner than we would have made before, or we give it a longer life so that its duration is longer. And that's what we're doing in these meetings. That is entirely different than it was 3 or 4 years ago, where we were really talking about what we were as a firm doing, how we were going to lower our carbon footprint, which we still talk about, but that's not really what these meetings are about. It's about the business opportunities and what we're going to do with them.
And if you were to run a phantom P&L on
Right.
the ESG piece of the business, if you will, what would it look like?
Well, it'd be a fraction of the overall, but
Right.
but I mean,
But it would be profitable?
yes, it would be profitable. Believe me, I wouldn't have everyone at the table if it weren't profitable. So, but it's not, what Dipender is talking about is different than a bank like ours or any big bank. We're heavily regulated. We have covenants that we have to match. We have CRA, which is Community Reinvestment Act, which allows us to look at things on a blended basis where we don't have to make market return on everything. It allows us to lend in below market rate to a third party who then can provide capital to somebody that might have been in an earlier stage or might not have been ready for a bank loan. So it allows us to do all of that, and all of that is encapsulated in this. But we did, $45 billion worth of environmental lending or investing in the last 3 or 4 years, and it's profitable.
But let me ask one question about that. On a margin basis, are you getting the same margin? And how do you think about that? Because I'm assuming, maybe I'm wrong, that the margin's going to be lower.
The only place it would be lower is in issuing a green bond. So green bonds are to do environmental work. If we underwrite it for a third party, so we just did one for a very well-known technology company, and they
Named after a fruit, maybe.
named after a fruit, maybe.
They want to make cars, I hear, but that's a separate
Right.
issue.
So they
Green
were
cars.
the issuer. In other cases, we issued a green bond for the city of Los Angeles, stick with me, for the city of Los Angeles, so that they could put in LED lighting in all their street lamps everywhere. What did it do for them? It immediately lowered their energy costs, so the ability to pay the coupon was much easier than it might normally be in a regular municipal bond. The only additional cost for us or anyone issuing a green bond is you have to monitor it. In other words, you have to make sure that happened. So you need somebody to monitor it, and you need to keep a record of it. But I mean, so what I'm talking about is de minimis in terms of a lower return.
Okay, I want to ask you about something else, which is a new report recently out, just I think in the past couple of days. It's getting a little bit of chatter both around here and elsewhere, from your bank by a quant who went to look to try to correlate stock performance and this very issue, ESG. Interestingly, lower volatility, you'd prevent, if you stuck in companies that scored very well on ESG, you'd have low volatility, you'd avoid bankrupt companies.
Right.
Lots of good things. You might, on average, marginally outperform the index,
Right.
but it was inconsistent. If you looked at technology, for example, or you looked at healthcare or consumer staples or financials to some degree, you would actually underperform if you had chosen stocks that scored high on an ESG factor. How do you think about that?
I think it's new. I mean, I think about it as being new. So if you can look at it a little bit differently, if you can think of it in terms of, this is a report from research analysts who I would say were in a prove it mode. So they wanted to prove it. What they could prove is, on average, not individually, but on average, lower volatility, longer term performance over time, less bankruptcy. And it wasn't so much those that invested in ESG as those that didn't. It's those whose practices, I think, were better. And there are certain categories that are going to benefit more than others. So in consumer goods, I don't know about the S and the G on consumer goods, but it does make practical sense that if they can lower their water use paper use, reduce their waste, it's going to be less cost to them, better for the environment. In the case of financial services, obviously there were some governance issues in an earlier
Yes.
part of this century. I think that everyone would agree if those were stronger, there would have been fewer problems. And there are a lot of instances at the moment in companies that are in the headlines that social sure would have been a help.
Right. Well, let me ask about that, which is to say technology companies, and you invest in lots of different technology companies or technology-related companies, historically have terrible ESG scores. They historically score horribly on these social issues and, more importantly, corporate governance issues. Which,
Not all of them.
not all of them, but some, in part because they either have dual classes of stock, they're controlled by a small group of people, there's no diversity, gender or racial. Does that matter to you?
So, you know, again,
Say
if
yes.
you, yes, yes, yes. In the startup world, you know, which is where we are operating,
Right.
You know, the teams are extremely small. It's very founder-driven. You pointed out the first company, right, where the founders had so much to do with it, and those founders can come from anywhere. In fact, to some extent, it's sort of the ultimate in terms of the democratization of ideas, because you don't have to be a large company that has existed for 100 years and have ways of doing business. People are coming out of the woodwork and starting these. So, you know, in our world, like Ann said, is a different world from that perspective, where the core purpose is doing good, and it's not about doing it at the margin, and not about doing it with 2% of your profits, or not about doing it as the 15th line item on your board agenda.
Right.
It's just you wake up in the morning and your purpose for being is doing good, period, along some of these
The
areas.
reason I ask the question, especially when it comes to startups that succeed eventually become larger companies that evolve, become public. They have boards. They report to us, all of us, one way or the other. And all of a sudden, in some cases, diversity, all of these things, the structure of the governance, all of a sudden matters in ways that it might not have originally. And so I was thinking from a startup perspective how you think about that, because if you could start the right way, it makes it a lot easier to evolve the right way later than have to switch gears after the fact.
And I think you'll find startups that start some of this very early on, right? We have multiple startups that have already well before they have an IPO or a public offering or even a sale, have set up nonprofit arms of their company. We have 3 of those.
Right.
We have one startup where right after the initial founders and investors agreed to expand the board, 2 independent directors were appointed, and the investors said, you know, they would give up their board seats for these independent investors to come in. And since all the founders and the investors were men, both those board seats, we said, go find qualified women for and put that in place. So many companies do, but many of them are not not large enough to step on it, like you said, right?
And you deal with bigger companies, but let me ask you the founder question. When you go and look at a company like Apple, at its zenith in terms of innovation, I'm sure Tim Cook wouldn't like me to say this, but when Steve Jobs was running the place, you could make the argument it was run by Steve Jobs and 3 or 4 white men. That's what it was.
Bro club.
Excuse me?
A bro
A
club.
bro club.
Yeah. Smart bro club.
So, but and this is where it gets complicated, and I'm treading into very dangerous territory.
Do it.
Well, it's really about just how to think about that, which is to say a lot of startups start because it's 2 guys or gals in a dorm room.
Right.
They associate with friends of theirs, which oftentimes may not be the most diverse group of people. They sort of self-select to like-minded individuals. And some of the folks who have, quote unquote, shot the moon have been a very tight-knit group. By the way, that has come back to haunt people like Travis Kalanick of Uber. So let's not suggest that this is a brilliant strategy in all cases. But the question is, on the whole, are we sure that it changes the dynamic?
Well, I don't think it's either or. And by the way, maybe some of the other companies, had they been formed more recently, would have run into more trouble. So we don't know that. But I don't think you can legislate genius. And genius is sometimes, not, it can be, I suppose, but does not always include high EQ. It might, but it doesn't necessarily. So I don't think it's an either or. If in the early days geniuses come together and they as founders, they keep a tight-knit group, that's one thing. But over time, that's when they have to have more diversity, particularly if they want to go public. That's going to be required. I mean, that's going to be de rigueur going forward. So it's not even that. I just think that you have to recognize sometimes in the early stages, people, particularly people that, like a Steve Jobs or even a Travis, they only believe in themselves. No one else is believing in them. They start with very little money. They have a lot of detractors. Most people don't want to see them succeed. So I get it. But that doesn't mean that over time that can't change. And I think that's where, when companies go from founder to expanding, you see the founders sometimes run into trouble because they have problems working well with others or evolving.
You have a take on that?
He agrees.
I agree, yeah.
Right?
Let me go back to the beginning of this.
Do you agree?
Yes, I do.
I want to go back to the beginning of this conversation because you said something that piqued my interest at the top, which was you said everybody agrees that climate change is one of the great challenges of our time.
With some exceptions.
With some exceptions. But I want to talk about that exception, and I want to talk about that exception because that exception lives at 1600 Pennsylvania Avenue, and how it has either changed, impacted, or even affected your own thinking about that environmental piece of ESG and how it's changed your investing strategy to the degree it has, which is that once this Paris Climate Accord has been upended, what does that do to what you're doing?
I don't think it's been upended, and I'll be curious what you think, Dipender, but it hasn't been upended. So most companies, ours included, have just gone forward. We can't be living in a response to an administration, this or any other. We can be influenced by it, and obviously if there's a law passed, we will be affected by it. But first, the president has said it isn't that he doesn't believe in climate change, he thinks this is a bad deal. I mean, that it also kind of evolves as his message. But I think...
two of his cabinet members have gone on the record to suggest that CO2 is not the main knob, if you will, on climate change, on the record. I mean, we actually had them on Squawk Box, no less.
Well, then there you have it. I mean...
No, I'm just saying, he may say he doesn't believe in climate change, but he has a number of people.
But anyway, the point is that companies, big public companies like ours who have made a commitment have been continuing. There may be some that have been sidelined, but in our case, and most that I know, we made a plan, we're going forward with our plan, our clients, our shareholders, and our employees want us to do it, we're doing it.
On the investing side, hasn't been any difference. I mean, it's a downer in general, just like it would be if you hear that the whole world has consensus around an idea, and even though there may not be specific tangible things that this consensus is going to do, it's great to know that everybody's on the same page, and everybody's sort of committed to it, and everybody will go off to their corners of the world and come back with amazing things because they had consensus. So it's a downer when you see a country like ours pull out of it because it seems so bizarre. But from a day-to-day investment point of view, it goes back to your earlier question about subsidies making a role. You know, a lot of these policies were not making, or a lot of these consensus ideas were not making a difference other than everybody feeling great about them, and it hasn't changed anything. I would say, I haven't looked at the charts, but you mentioned Tesla. My guess is Tesla's market cap is up from probably around $40 billion before the election to, I know today it's like $67 billion. So that electric car company, which is all about electric transportation, has now become more valuable than Ford, has now become more valuable than GM, and is approaching the valuation of Volkswagen, the largest car company in the world. And it's doing it while selling tens of thousands of cars, not tens of millions of cars. And so if that's an example, the markets have said,
Right, and we're underwriting more green bonds and issuing green bonds that are oversubscribed as recently as just a few months ago.
And on and on and on. She mentioned LED lighting. Japan, I think, installed like 60 or 70% of all its lighting was LED lighting because it's, again, a better product, cheaper, better on every front. If you look at the rest of the world's targets now on solar, it's mind-blowing. I mean, it's like they're measuring them in hundreds of gigawatts now and signing contracts that talk about solar energy being 2.5 cents a kilowatt hour, right? It's all of that. That toothpaste is out of the tube.
Right.
No amount of politicking is going to hold that back. It's a downer, but people who care about the quality of the product and care about the cost, at the end of the day, those are things that matter.
And you represent a consumer-facing brand, one of the largest in this country. So when the president ended the accord, and you and other companies came out with statements to the contrary, effectively criticizing the decision, what was the thinking internally? Meaning, does everyone say, there might be a Twitter storm at 3 a.m. in the morning. He might come after our company. I imagine there are customers, I would imagine lots of them, who are Trump supporters. They're probably, you probably have customers, I imagine, on both sides of the aisle. Right. How did you think, though, about that particular issue, given how divisive things have become in this country?
Well, I think our approach wasn't to be critical of the president. It was simply to say, we've put this in motion and we're going to continue with it. And most companies are prepared for a Twitter storm. I mean, it could happen. So it's not our intention to put a stick in the eye of the president. It is our intention to stick with what we think was the right thing.
Right. I want to ask you, as an investor, how often you come across investments that you actually say to yourself, this would be an awesome investment. I think this is going to go. But it really doesn't fit within the measures of the things that I think are good for the world, and therefore I'm not going to do it. And I'm not talking about sin companies. I'm just talking about straight up, I don't know, one of these newfangled financial services banks that wants to be the next Bank of America, that you may think is not good.
So, you always have to have aspirations, and you have to have a focus, and you have to have an area of expertise. And our area of expertise is one. Yes, living in Silicon Valley, you come across lots of ideas. Now, we also have a network of other investors. We are investors in other investors, and so there's lots of opportunities to take advantages of good investments that are not bad for the world. But that's not what we wake up and do every day. We have lots and lots of opportunities right now to invest in companies that are both.
Are there sectors? Give us some ideas. Are there sectors that we wouldn't think of, where there are some really unique and interesting ideas that relate to?
So, by the way, financial services is a big sector. Banking the unbanked in most of the world is a huge deal. Access to capital. There's a lot of the world that does not anywhere come close to achieving its potential because of lack of access of financial services. So we have invested in a financial services company in Nigeria, which is now growing across West Africa, and is becoming a very large player. It's like 60% of the market.
Okay, let me play truly devil's advocate.
Yeah.
You'd invest in a bank in Kenya. I get that. I could make the same argument, by the way, that a bank right here in the United States is helping is helping all sorts of people in all sorts of ways. Yeah. But I would bet you wouldn't invest necessarily.
But we're a mature company, and you're talking about. Well, I don't want to say it for you. Go ahead.
No, but you're right. I mean, the measures are not that different, right? In fact, many of our companies are born in the U.S. because many of them have technology at the heart.
Right.
And that technology is going to be applicable to banking in the US, and it's going to be applicable to banking in Africa, and it's going to be applicable to banking in Vietnam, and on and on and on. We've done an education services company that was born out of an idea that came out of a brilliant PhD student from Vietnam, and it's going to be a large global marketplace. So, these ideas can be born anywhere, and if they're really large, ideas, they can become global very quickly.
It also keeps big companies on their toes. So a remittance company, Venmo, which has gained a lot of traction.
Part of PayPal.
Right. Has certainly gotten the banks interested. So now we've put out collectively this product Zelle, which we think will take the market. So, I mean, it's always good to have somebody new come along to do something that you think, wait a minute, we should have been doing this. So.
Right. How often do investors come to you these days and say, we want you to we want you to build more products like this? I mean, is this...
With social impact?
Yeah.
Or, I would say, first of all, it's investors, it's clients.
It's clients.
It's clients. And I don't know, we've done about $11 billion of social impacts, purely social impact work in the last couple of years, which, you know, relative to our overall balance sheet is small, but it's $11 billion we didn't have just a few years ago. So we see it as a growing trend.
So I'll give you an example that we would look at in the financial services industry. You know, one of the things that we've been focused on over the last couple of years, outside of our core technology areas, is bringing capital to finance these technologies and these ideas. One characteristic of a lot of this clean energy, for example, is that it takes an upfront, it takes a substantial amount of capital upfront, much like building a nuclear power plant or something that'll pay off over 30 years. But people got used to that idea. People haven't gotten that used to idea about building a solar power plant up front that'll pay for itself in 20 years. So a lot of work is going on around products that will enable the flow of capital from, I don't know what the latest number is, you probably have it better than me, you know, $19 trillion of negative yield in the world, to some very exciting yield around these types of deployments in the rest of the world. And bridging that gap is going to take creativity, and it's going to take maybe even new companies.
Okay, we're going to run out of time, and I want to let you guys ask some questions. I'm sure they're going to be a lot better than mine. I know we have some microphones coming around. You got the cheap seats in the back, so you get to go first, ma'am.
Thanks. This is actually less of a question and more of an expression of solidarity for both of you who have been such brilliant spokespeople on this topic. I run a social enterprise incubator in Washington, D.C., and we deal with detractors all the time who believe that, you know, this can't possibly be something that's going to be a future trend, that it's going to return market value, let alone beyond market value. I think a really useful example that I'll just bring to the table for people who can't quite envision this, that I find is very helpful to help people in getting what this is, comes from one of our ventures. It's called Misfit Juicery. They take vegetables and fruit that would go to waste because they're too small or a funky shape and you can't sell them in Whole Foods, and they turn them into juice. The brilliant thing about this is they have a competitive market advantage on the price of their vegetables and fruit, that they can then, you know, create cheaper juice, undermine their competition, and ideally prevent more waste. So it's a virtuous cycle, and I think that, you know, these companies that can create that at the core are going to be the future. If you understand the statistic that nearly 50% of the companies in the Fortune 500 are going to be extinct in 10 years, I think the question then becomes, how much of our value system are we going to bring to bear when we make market choices? And our big bet is that it's a lot. So we have an optimistic view of humanity, that they are going to make ESG choices in their purchasing going forward, and therefore these companies are the wave of the future that will replace those dying companies. So that's my 5 cents. Not Tesla yet, but I really believe in this, and I really think it's ultimately a value choice.
Okay, we got a question right here, ma'am. Red glasses, yeah.
Thank you very much. For clients who hire you for asset management services, how do you execute ESG strategies? Is it more negative screening? Is it more proactive? And then second, beyond financial returns, are there other measurements that you apply to the strategies?
Well, yes, we apply other strategies, but the point is that usually the customer is looking for market return. So it may, first of all, you probably have a portfolio. It is on a blended basis. What do you want your return to be? So that's the first thing. And what we do is we have people come in, obviously we go through what is your area of interest, whether it is women-owned businesses, the environment, some other social perspective. So it's a series of questions. What are you interested in? What are your expectations about a return on equity? There are companies that give you a market or better return. There are many more that don't. They give you a return, but they may give you the return of a municipal bond, something more modest. But in all likelihood, that's part of your portfolio anyway. It may have a pretty low volatility too. So green bonds have a very low volatility because they really act as a form of a municipal bond.
Right there, yeah.
Thank you, Anne and Deepa, for sharing your thoughts. I was very curious to hear, you spent quite a bit of time talking about the E part. And I know Bank of America has done some terrific work around investing in women and girls. And if we look at financial inclusion in particular, 2 billion people don't have access to basic bank accounts, 1.1 billion of them being women. And you have 300 billion annual credit gap for women-owned enterprises. So I'd be curious to hear a little bit more as to why have you decided to go and focus on investing in women and girls, and how do you measure return on investment in that aspect? Thanks.
Investing in women and girls. So, well, we do it in a different way in different parts of the world. In some parts of the world, we are out there doing mentoring, largely mentoring and working through third parties because we don't bank on a retail basis, meaning individual basis, outside the U.S. Inside the U.S., we do quite a bit more. So we have a product for loans, affordable loans for women and men, actually, at an earlier stage. We also do a program with Tory Burch. She does the mentoring. We create the capital by working with CDFIs. Can I have 1 second to explain what that is?
Please.
Okay, so a CDFI is a Community Development Financial Institution. This is something Dipender wouldn't be interested in, but because of CRA and because of the way big banks operate, we are interested in. Here's how it works. You come to us, you're at a very early stage, you need some money, but you have no record, no track record. We would be unlikely to lend to you, not only because of ourselves, but we have our partner, the regulators. And so what we'll do is we will put you in touch with a CDFI, a Community Development Financial Institution, who can lend to you. How is it they have the money? They have the money because a bank like ours lends them the money at below market rate. So we give them money at below market rate. We also usually give them a gift, a philanthropic gift to lower their administrative costs. So that's a two-way, reduction in their costs. They lend to you. Your loan is below. It's lower than a credit card. It's lower than an online lending club or something. So it's more affordable, and they also give you mentoring and counsel around starting a business. That's been very successful. In the last couple of years, we've lent just in that one program alone $25 million. Now, we're not getting market return on that, but when you're as big as we are and you have 50 million customers and you have $1 trillion in deposits and 900 billion in loans, we can afford to do it.
Got a couple more questions in the middle there. The ideas had.
Thank you. Either for you, Andrew, or the lady in the back, when she said 50% of the Fortune 500 will be out of business, extinct, does she mean dead or merged into another company? Because you know that consolidation and mergers continue.
Letters.
I don't know the answer. What are you speculating?
Well, you can find some of the information online. Various sources have quoted it in different ways, but and it's speculation, but it's based on rates of business extinction, and they're both of those cases you mentioned. So both merger and going under.
Okay. I'll make it convenient. You have your hand up, sir, right next to her.
Hi, Jason Saul. One of the questions I have is, are we measuring the wrong thing? So we throw out ESG all the time as sort of pablum, but if you really double click on what they mean, most of them are just compliance standards of whether companies are not doing bad things, or whether they have women on their board, or whether they have certain types of accountabilities. But is that really the best measure of the positive social, environmental impact that companies are having? And if we had actual alpha-oriented ESG data that showed a correlation to consumer demand, say, or to growth, might those be better statistics that could revive interest in this area?
Well, this report, I think, will speak to that. So this report by Bank of America, Merrill Lynch, Equity Research, Savita Subramanian, goes through the positive. Now, there are some holes in it, but it goes through the positive, not the, it isn't a compliance thing. I'll give you a
I think it's a positive and negative. I think it's
just
more
positive.
mixed.
So, no, it is positive and negative. But I will say this. I'll just talk about my own company, that today, 50% of our workforce are women, 43% are people of diversity by either color or ethnicity. The senior management is 40% diverse. The board is 30% diverse. It makes a difference. It makes a difference when there are different voices around the table coming up with more creative ideas. So I'm not going to argue the founder issue, but when you mature and you're dealing with issues of the world in a global business, not to have represented the very people that are your customers is crazy. So that's the reason you have diversity.
Sneak in a couple more questions. Stuart's in the front here. He's been a very loyal follower of our panels. I've now seen him at all three today. So.
How do you look at normal, I mean, companies that are of size, that aren't startups and aren't focused on the ESG, how do you look at them in terms of if they are more aggressive in those areas than others?
More aggressive in what area?
In ESG.
Well, that's really what this report that Andrew is mentioning. There's evidence that companies that don't invest in ESG are doing perfectly fine. I would say that there is a move globally to become more ESG focused. Maybe some cases it's for compliance. In other cases, I think it is skating to where the puck is. And we see more and more evidence that those companies have less volatility, less apt to see bankruptcy, and better returns over time. It's not universal, but we do see enough evidence that gives us, I think, a positive outlook.
Two more things I've seen, better operating results and something pretty tangible, lower cost of borrowing is what I've seen.
And just to put a fine point on it, the report that she's referring to specifically uses an index that was created by Thomson Reuters. So Thomson Reuters went out and looked at a universe of, I don't know, I think several thousand companies, and literally ranked them based on a variety, probably a dozen, maybe 15 different categories in the E, S, and G, and I think they gave them A+. I mean, it was literally great grades. And so then what the bank did was take those grades, go back to 2005, and look over a decade to see what happened to their performance. So if you had a high grade and you had high performance, terrific. If you had a high grade and low performance, maybe there's no correlation, or does this matter? And that's sort of the larger
So
question.
that's why the jury is somewhat out. I would say, though, because we had to go historically and not prospectively, that it might be, that's my point, it may be that over time, it would have a more positive, I mean, 3 years
It was also
from
a
now,
particularly unique time because it started in 2005.
right.
So if you start to think about, there was a little intermission in 2008. We have a couple more questions, and I want to sneak them in if we can. Yes, sir.
In your opinion, can you see credit cards being obsolete in the near future?
I think there's several technology companies right now working on doing just that. Yeah. So yes, I can.
Is that doing good?
Less plastic. I mean, I think that the question is, are you asking if the physical credit card might be obsolete or the idea of credit?
physical credit card.
Physical credit.
Yeah, I think certainly there will be a time where you wouldn't have to have a physical piece of plastic, but the service would be the same.
Yeah.
Okay, thank you.
I mean, you already see probably a big trend. I haven't seen any reports around it, but just with the simple increase in online retail versus physical retail, the actual physical use of a credit card has probably plummeted compared to actual physical use. Right?
I'd wager, by the way, in China, 5 years, no credit cards.
By the way,
I think
in a part of the world where this has caused a lot of ripple and a lot of pain and sort of that cycle, is that instruments other than pure cash are helping reduce corruption and are helping increase transparency because all cash transactions are
It's
tracked.
on the record. Yeah.
That's right. It's on the record. And as you may have heard, in countries like Kenya, where mobile minutes came in, very quickly they became like 40% of GDP, and that was something as simple as mobile minutes.
Okay, let's sneak 2 final questions in, ma'am.
So given the increasing frequency of cyber attacks and the increasing effectiveness of that in a world that doesn't have physical anything, not physical cash, not physical credit cards, can you comment on that future and what people might do or what your recommendations might be? Because it looks like we're stepping into a place that's really interesting, but also in some ways more vulnerable.
Did you say cyber tech or cyber tech?
Attacks.
Oh, attacks.
Yeah, like the hostage, taking hostage people's data that particularly hit England hard with whole hospitals and health systems
Right.
and clinics.
I don't think it's the physical use of a credit card that would make the difference because they're just as vulnerable. I think the point is that you have to have excellent cybersecurity, and the larger institutions have them and the smaller groups don't. But I think that there are innovations coming forward that may address it. I don't know if maybe you know some of them.
So I think just to echo that, I think the fact that a credit card is the holder of a few pieces of information doesn't make it any different than anything that would hold those pieces of information, right? Yeah. And so I think my take on it, we're well past that point where it's not like we're just entering that realm of where more transactions are happening without physical cash. So I think we have to solve that problem, just like we have to solve cybersecurity issues on our grid, cybersecurity issues on our insurance networks, our health networks, our day-to-day lives, and there's a huge amount of focus on it. In fact, I think there was a New York Times article just focused on this over the weekend, and technologies. But for every technology, there's a way to break it. So this is going to be one of those hopefully virtuous cycles and not a vicious cycle.
We spend several $1 billion a year on that alone. So, I mean, it's not an issue that goes unnoticed. I mean, it's a real issue.
Let's take one final question. Go to you.
Hi, my name's Amber Mahud. So I spent my career, basically, I started out doing corporate governance research before Enron collapsed, and spent the bulk of my career working with hedge funds and private equity on increasing transparency. But recently, I've taken the step to become an entrepreneur, or aspiring entrepreneur, to launch a website focused on responsible consumerism and mindful living. And with the hat of an aspiring entrepreneur, I was just wondering what your 3 main tips might be for things to look out for, how to get there, what to look out for. Thank you.
How to help start your company?
No, just as an entrepreneur that one needs to look out for in order to make it to a stage where you're investable, I guess. I've been on the other side of the table. I've never been on this side of the table.
Well, if I were you, I would look at this CDFI Tory Burch Foundation. I mean, you seem like you might be a very good candidate for it.
One of my clients actually works with her. One of the brands I work with already does work with her, yes.
So does that mean it's not a solution?
No, it is, yes. It's a great idea. Thank you.
Okay.
I would say,
you're the startup investor.
Look for a really big idea, right? It usually takes the same amount of effort to go after a small idea as it does a big idea. I think many entrepreneurs make that mistake. They feel like because they are just one or two people, or they're starting out small, that a smaller idea is a better thing to go after. And I would say, don't fall for that, and find great people to work with. Don't think of something that you can just do by yourself. Find appropriate sources of capital to that example, right? Everybody usually assumes that the cool thing is to go find venture capital. Venture capital funds a very small percentage of new ideas and isn't always the right tool. So find the right sources of capital and pursue what you're passionate about.